Lots of talk about interest rates and where they're going and what they're going to do and how low will they go, and fixed rates and variable and all sorts of things like that. I thought I'd take a little bit of a different tack. Instead of talking about what all the other experts are talking about, I think it's more important to talk about the tips for taking advantage of these current low interest rates. And there's 5 key tips that I think that's important that we look to take advantage of. Let me take you through them. So the first tip, and I think the most important tip in a low interest rate environment with rates reducing, is undertake a full review of your current facilities. With rates coming down, people tend to be complacent. They think they're on the best deal. Only recently I was talking to a medico who has quite a substantial property portfolio and thought that given his rates were around about 5%, just under about 4.98 I think they were, that he was getting a really good deal. When I told him that he's probably about 0.5% out of the market and on his portfolio around about $3 million, that was going to be a saving of around $15,000 a year. That's just the complacency I'm talking about. So if you bring that back to, and you take a zero off to most average borrowers, and they might have a $300,000 home loan, if you're 0.5% out, that's $1,500 a year. That's just over $100 a month, and that might be the difference between you starting your investment portfolio or getting your next investment property. So please undertake a review. The banks are actively competing for your business. It's a great opportunity to access some funds, some buffers, some other investments that you may want to take. So the first point, undertake a review of your loans, please. And of course, here at Intuitive Finance, we would love to be able to help you. The second point is gear your repayments now at a higher home loan rate. And what I mean by that, and generally I use in today's market, with rates between 4.5 and 4.7% that most clients are able to access, is look at your rates and start to gear your repayments at 6%. Why 6%? Look, you can do 7%, you can do 8%, you can do whatever. The reality is, in today's current low market, rates aren't going to stay this low forever. So let's start to gear up and build a buffer, reduce your home loan, build some equity to enable you to do the other things in your life you may want to do. And just for example, okay, if we've got an average home loan of $400,000, if you factor your rates at 6%, okay, all of a sudden you're going to be paying around about $2,400 a month or $550 a week. If you bring that back to the current day rates at 4.75%, you're going to be paying about $2,100 a month, so about $300 a month, or $480 a week, so about $70 a week difference. Now, it doesn't sound like a lot, and people often say, oh, that won't make a big difference. It does. By gearing your repayments at 6%, let's say at $550 a week instead of your normal $480 per week, you are going to save around about, on a $400,000 loan, around about 7 years off your mortgage and just shy of $93,000 in interest savings. Now, if I ask most people how long it take you to save $93,000, most people look at me and laugh. So there you go. There's your simple tip to save over $90,000 just by being a little bit disciplined and gearing your rates at repayments that, all of us, 18 months, 2 years ago, we were actually paying anyway. So use the current rates, factor in a higher repayment, and let's start reducing. So that's the second tip. The third tip I'd really like to implore everyone to have is set up an offset account. Still, so many people don't know what these are, don't have them on, and don't use them properly. An offset account basically sits against your loan with any savings you do or don't have to help you reduce your interest. And let me give you a really rough example. If you've got a loan of, if we go back to the average loan of $400,000, but it's $410,000, and you've got $10,000 in savings, if you've got that offsetting, you're only paying interest on the differential. That offset account sitting there for $10,000 again can save you in and around between $20,000 and $50,000 just by sitting $10,000 there, depending on the size of your loan. They're really powerful things, and there's not much to be done to get that on and to assist. So please, everyone, if you don't have an offset account, get one on. Again, all of these tips that I'm giving you, of course, we'd love to be able to help you. You can contact us here at Intuitive Finance on the website www.intuitivefinance.com.au, or give us a call on 03 9598 8544. We're more than happy to help. The next tip I want to really try and encourage people to not do, and it's funny, I've been talking about what you should do, is taking on bad debt. And what I mean by that is rates are low. You know, if you've got a sound job and people are thinking, you know, now's the time to upgrade to that new car or buy the boat or go on a holiday. Now, I'm not saying don't do these things, but make sure you're not taking on bad debt. So we're not taking on a personal loan, we're not taking on a car loan, something like that. If you've got any credit card debt at all, now is the time to get rid of it. You're still paying credit card rates at around 20%. If you've got, you know, funds sitting that month to month you've got on that, you need to get rid of that. You need to get into a lower rate environment. We need to get rid of those. Now is the time to really eradicate our bad debt, our personal loans, credit cards, things like that, and please don't be taking on new bad debt. Now's the time to take advantage and set yourself up for the future. With a little bit of discipline now, you'll get those things in the future by getting ahead in your home loan. And so that's point 4. The 5th point I really like to get people starting to think about is just really start to look at your fixed rate options. I'm not saying today rush out and fix your rates, but start looking at them, especially those of you clients out there that have larger value loans or significant portfolios. Rates are at all-time lows. We all know that. There's been more than enough commentary about that. But you're starting to able to fix for 3 and 5 years, well under 5%. If I had said to you 2 or 3 years ago, you know, would you fix for 5% at 5 years at, you know, under 5%, you would have jumped at the chance. So I'm not necessarily saying right now is the right time. That'll be quite specific to individual circumstances, but everyone should be starting to at least explore the options and start to get a plan in place for looking at the fixed rate options. So there we go. I think 5 great tips that'll help you take advantage of these low rates. Undertake a review, gear your repayments at a higher rate, set up an offset account, don't take on bad debt, and start to look at the options of fixed rates for those of you with significant portfolios or larger value loans. Of course, as I said earlier, we would love to be able to help you here at Intuitive Finance, and I look forward to speaking to you soon.